It is ill-advised to go out into the ocean when the sea recedes, especially if the seashells look prettier that day. Here's what I'm getting at. Most of the time in nations that are surrounded by water, in the past they had not had great sirens that would ring when a tsunami was on its way. And one of the key elements in the signs was the water would recede and all the pretty seashells would come to light. And so you take a bucket out and go gather as many as you could. Well, unfortunately, now we know today that is not a good idea. And very similar things happen in our finances. So in this segment today, my co-host Daren Hardesty and I are going to talk about, are you prepared for the next tax tsunami that's coming? And will you go out there with a bucket to gather the seashells? Or will you have prepared well enough in time so when it does arrive, you'll be on high hills? Join us. Consider this program. Look forward to having you here. Welcome back to Consider This Program. I'm your host, Grant Soliven.
And I am Daren Hardesty.
Daren, it is so good to have you here. And unfortunately, I didn't bring my swim trunks, my friend, but we are talking about tax tsunamis.
Yeah, I got my surfboard ready to go.
Oh, I love it. You surf, actually?
No.
Oh, okay. No. Well, you had me excited there for a second. Well, folks, thanks for joining the show. Daren and I, as you heard in our earlier portion of the show, we want to talk about what's coming, right? We're getting ready to turn the corner into tax filing season. That means we're all going to show up to our tax preparers, our CPAs, and figure out what has gone on in the past, how much did we pay, and for some of us, do we owe anything? And that's what's dominating our thoughts currently today. But unfortunately, what that allows to happen is it allows that tsunami that's coming, the tax tsunami that's on its way, to continue to build up. And as more water recedes from the shore, meaning how much more can we defer every year and every year, eventually the water will come back. And that's what we want to talk about today. We're going to set up what are some of those deferred accounts that really are good in some instances, but can be accelerating the problem. What is this tax tsunami we're actually talking about? And Daren, what are some ways to get around it? So my friend, as we're getting into the show today, what are some of these deferred accounts? What happens if I have a job and have a 401k, I have enough to defer in an IRA? What are these accounts? What are they? Help everyone understand what we're looking at, what we're talking about.
Absolutely, Grant. And like I said, it's a pleasure to be here with you. And I hope to educate you guys and give you some information you may not have thought about. But essentially, there's different buckets of investments that we can put our money into every year. The most popular is the 401k or 403b that you have with your employer. You also could have what's called a traditional IRA or a Roth IRA. And then there's also brokerage accounts that can be individual or a joint brokerage account with your spouse. So there's different accounts. They all can be invested the same way, but how they're taxed is what makes them different. And so today, what we're really going to focus on are those tax-deferred accounts. So what it essentially means, just like the name, you are deferring, moving taxes from today so that you can pay taxes later. Defer does not mean never pay tax. It just means, hey, this year you don't have to pay tax. So as Joe always says, tax policy is social policy. Mm-hmm. So why have these tax deferred? Why would the IRS be okay with you not paying more taxes this year? Well, the idea is that, hey, we want to incentivize you to save your money, to put your money in, which is a very good thing. But at the same time, you can't forget that just because you're kicking the can down the road, if you will, that tsunami of taxes aren't going to be coming. And what it all comes down to, Grant, is people think the concept, and I have an article coming out soon that talks about this, but people think that, hey, if I save more taxes this year, if I do everything I can to save taxes this year, everything I can't do to save taxes next year, and you do that your whole career, you think that overall, the cumulative amount, you're going to pay less in taxes. That makes sense if your investments are linear. So as a former math teacher, when you're saving every year, you're putting money in. Think of it as a linear line that's going up and to the right. It's just slowly you're putting money in. But what people don't think about is that investments don't grow in a linear fashion. They grow in an exponential fashion, which we love.
Compound interest.
We love compound interest.
Right.
So that exponential growth starts to take off, and all of a sudden now you have these tax-deferred accounts where the amount that you have put in is much less than the amount that's actually been earned. And then you get down to the road where you say, hey, I need to actually use this money. Well, now all of that money that's in those accounts is now taxable. So by kicking the can down the road, it was great for that year, it was a great opportunity, but now you've set yourself up for a huge tax burden, potentially, when you get to the point where you have to start taking that money out.
That's a really great point. And so what Daren's talking about, folks, for some of you that have been in meetings with our families, or families that have been in meetings with our team, you know that we talk about the tax wrapper, right? Daren talked about it. All the investments that go in the tax wrapper, right, that's how the IRS is going to gauge the amount of income tax they apply to us in a given year or in the future. And trust me, folks, CPAs are not bad people. Tax preparers are not bad people, but they are bent on having you pay as little tax today as humanly possible. And many of them, not the partners we partner with, but many of them forget that tax codes change, and tax codes are likely going to go up when they sunset in 2026, if not sooner, which Daren leads me into the tax tsunami.
Yes.
So what happens at age 72? What's going on in the current tax code no one's really paying attention to, and why is that a problem?
So there's multiple events happening that create the tsunami effect that we keep alluding to. So at 72 currently, that's when you have to start taking what's called a required minimum distribution. All right, we call them RMDs. That's an amount that, based off the amount that you had in your account on December 31st of the previous year and your age, you get a certain amount that the IRS says you must take this out. So whether you've been holding off on taking money out of the account, well, at 72, you're forced to. And if you choose not to, there's a 50% penalty if you don't take any of that money out. The second thing is when you're 72, you've also started Social Security. And if health is good, hopefully you've waited until you're 70, so you've had the highest benefit that's allowed to you through Social Security. So you have both of those, the RMD, the Social Security being added to your AGI. Let's say you have a pension, that pension from a former employer. Now that's included into the mix. Let's say you have rental property or other income-generating assets. All of that's being added together, creating this huge taxable event. And then the kicker that most people just choose to forget because you don't want to think about it is what we call the widower's tax or the widow's tax. So when you or your spouse passes away, the other will inherit the tax-deferred accounts. The RMD value will not change. That RMD value is going to continue to come out. The Social Security will get a little bit less, but not a whole lot. So now you are a single filer rather than a joint filer, and all the same money that you were bringing in before is now almost doubled in tax just because you're now a single filer. So all of those things happening, we start to see our people that are 72 or older, they're getting taxed at a higher rate than they've ever seen just because of all of these different events coming together at the same time, hence the tax tsunami.
100%, and Daren, very well explained, by the way. The key element to this, folks, is we're actually getting penalized to be diligent. Mm-hmm. So we are told our whole lives, save, 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 save. And if we don't do it the right way, we don't add tax diversification to the overall pool and pot, what we get stuck with is paying taxes today and then potentially paying higher taxes in the future. The old adage is this: why are you not going to defer taxes for your future? You'll be paying less in retirement. Ask the families that we serve if they're paying less in retirement. Many of them are not because of these pensions and Social Securities, and they've been diligent savers and have these giant nest eggs, compound interest. They're 72 and older, and we don't have the same ability to defer the taxes because there's no more W-2 wage income, etc. And so they're stuck gathering seashells, and the tsunami is coming. It's not that they did the wrong thing. They were just slightly misled along the way. So, Daren, getting into it, the tsunami's coming. Mm-hmm. For many of those who are listening to the show, for many of us who are putting money away, how do we get away from it? How do we get up on that hill, out of the way of the tsunami as it comes? If you talk about tax diversification for a minute, and also some of the strategies we deploy to get our families into a safe haven.
Sure. So it depends a lot on where you're at in your phase of finance. If you're somebody like us that still has 25, 30 years left of being in the workforce, the simplest thing you can do is start putting more money into a Roth inside the 401k, if the 401k allows it, or into a Roth IRA. A Roth, essentially, you are agreeing to let the IRS tax you for that money for this year, but that money is going to grow tax-free, and then when you need it later, it's going to come out tax-free. So the more that you can have in a Roth account that is getting that compound interest where the growth is higher than what you've actually put in, that becomes an extremely valuable asset when you get to retirement. And if you're a little bit closer to the end of your career, well, we can start looking at, either adjusting the contributions in your plan, or we can actually start looking at Roth conversions. So a Roth conversion is when you take money from an IRA or a traditional IRA and you convert it into Roth money. So essentially you get a 1099 that says, hey, I took money out of my IRA, but really you didn't. You just moved it from from one account to the other. So you can start kind of taking advantage of a preferential tax rate right now to move money into the Roth. And so all of these things, especially our families that are 65, they're about to start Social Security, they're in retirement. Why start Social Security? Why wait? This is, if health is good, this is a great tax planning opportunity for us to say, hey, you've got a 5-year window, 6-year window, depending on what it is, that we can do some conversions when you have a much preferential rate to get money out of those tax-deferred accounts at a good number rather than waiting for the IRS to say, now you have to take it out at their number. So it's not too late. There's definitely ways to prepare. Get on top of that hill and make sure that you're setting yourself up. The idea is that you just want to be thinking always about tax diversification. It's not always best to do tax deferred. It may not always be best to be after tax, whatever it may be, but thinking about how can I spread my wealth into multiple tax diversified buckets.
Absolutely. Well, very well said, Daren. And for those of you that are in the distribution phase of finance and you're thinking, goodness, it's too late for me. I don't work anymore. I'm taking money out of my accounts now. I'm already out in the ocean. I can't get back in time. You can actually. There's never a late moment as long as you take action. And so that's one thing we want to recommend today is it's never too late to begin building tax diversification. And at the same time, one of our team members is going to help you understand what bracket bumping means, etc. So please, if you're looking for more educational content or you want to talk to somebody from the team, please reach out to us at 800-928-4001. You can ask for Brittany. She'll kind of educate you on the process and tell you what you need to bring in for a meeting for next steps. Also, if you want to tie in some of what we've talked about to a written document, Aaron Rayum, our Director of Financial Planning, and Joe Clark have written articles you can find on our website. Those articles, there are 2 tax codes, one for the informed and uninformed, and then designing your distribution plan. They're all out there for you guys to use as valuable resources. But thank you for being part of the show. We'll be back with the next segment here in a minute. Looking forward to enjoying that with you guys here shortly.